All right. You ready, Alp?
I am.
Excellent. Well, thank you everyone for joining us today, and welcome to session number 4 of our 2023 annual monthly workshop series. If you don't know already, my name is Jason Dahl. I am a certified financial planner and a partner at AFS Financial Group. And with me today, as typical, is my colleague Alp Adebeck. Alp is the founder and managing partner of AFS. And quickly, I know we have a number of folks tuning in from the AFS 401k side. So just as a quick refresher, we at AFS Financial Group operate as a separate entity from the AFS 401k retirement services team, but we definitely collaborate on another number of items, especially when it comes to our financial wellness programs, such as today's presentation. Also, as always, please ask questions at any time during today's session. We will keep everyone on mute, so if you could please ask a question or make any comments if you have anything to add or experiences related to today's conversation. Do that by typing it into the Q&A link on your screen. We will keep our eye out for that throughout the presentation. And thank you to those of you who sent questions ahead of time. We got a number of excellent questions, and we will definitely be covering all of those. I feel like there might be one that we'll say we need to get back to you on, but I think all the others, Alp and I felt confident we'll be able to cover those in today's presentation. I always like to add that one of our favorite questions is, can you schedule a time to speak with Jason or Alp? And we want to encourage you to please do that. So follow up with us directly after today's session if you have any questions about today's material or anything. We are more than happy to schedule a call, Zoom meeting, in person. We definitely still love what we do, and the best part of what we do is connecting with folks like yourself to help you solve personal financial planning puzzles. So again, don't hesitate to reach out. So let's get rolling.
So Jason, let me give you let's tease the crowd a little bit. I want everyone to think about what the maximum benefit will be for somebody that delays taking Social Security till age 70. Say they've had a strong work history. So what's the maximum Social Security benefit that person will have if they turn 70 in 2023?
This year.
So just so everyone understands the value of this benefit, that number is $4,555 a month, or $54,660 a year for somebody that paid basically the most into the system. It's capped, and delayed taking it till age 70 and started in 2023. And also keep in mind that payment is inflation adjusted. For the last couple of years, they've actually given really good, strong inflation adjustments. In other years, we always kind of chuckle a little bit about the formula where we think it's still inflation adjusted, but maybe not what the real number should be. But last year, I believe it was 8.7%.
Yeah. So
keep that in mind.
Significant. So yeah, no, great. I love it, Alp. That touches on a number of items that we're gonna hit on today too. So it's a good,
very valuable benefit.
Hopefully we got your attention with that, because I completely agree. I think probably our biggest goal for this presentation is, one, to help give you some of the tools to be able to make an informed election when you do file for Social Security, when you file or a spouse files, or maybe you have a loved one who's in the process of considering and making a decision on filing. So we want to help you understand the important questions to be asking and considering, because Social Security retirement benefits are a valuable asset, just as Alp mentioned, and it's worthy of you thinking through your election options thoroughly. And I always like to add too that if you logged on a little earlier, you may have heard Alp and I talking that this presentation, we've been doing a version of this for many years now. We understand, we've learned a lot about Social Security benefits over the years. They've evolved, and they will continue to evolve. That is undoubtedly going to happen. But it's not uncommon where we'll get asked a question where we'll say, we want to double check that, or we want to get the full details from somebody to make sure, because it can get complicated. And it's not just as easy as, oh, should I start it as soon as I'm eligible or not, right? There can be a number of different variables that play into it, and it's valuable. So we want to help everyone sort of feel empowered to be able to make an informed decision.
I mean, think about for like a married couple right now, if both of them delay to age 70, right? I mean, you're talking about over $100,000 a year. And I recognize 100,000 is not what it was 5 years ago when we throw in inflation, but it's still just a very valuable benefit.
Yeah. So I'd love to start today's presentation with a quick introduction. So this lovely lady is Miss Ida Mae Fuller. She was the first beneficiary of Social Security retirement benefits. She received check number 000000001 for, drumroll, $22.54 in 1940. Now, of course, an important component to Social Security benefits has always been around life expectancy. And we'll talk a little bit more about that. But a quick question, just to kind of have you think about this, or if you want to type it into the chat box, feel free. But does anyone know what the Social Security full retirement age was for Miss Fuller? Right, Alps talked about delaying all the way to 70. I mentioned you could file as early as age 62. But what was considered the full retirement age in 1940? If you know it, it was age 65.
We had one guess of 52.
Yeah, so it was actually 65, starting in 1940. That has been adjusted only once since then. Back in the 80s, it got adjusted up to the current tables. We do expect that to be adjusted again at some point. We'll talk about that in just a moment. But just kind of as a sort of extra credit question, what was life expectancy for Miss Ida Mae? And a little bit of a trick question. So at birth, life expectancy would have been 62 at the time, but having attained age 65 in 1940, life expectancy was 79. All right. And so why do we kind of talk about that? And we got a couple questions ahead of time, sort of to this point. It's just sort of that elephant in the room that gets brought up pretty regularly. Is Social Security still going to be around, right? There's any number of news articles. You could Google it. You know, when is Social Security going to run out of money? When is the trust fund going to run out of money? And so sort of
we get asked this more often than you believe, right?
And so I'll say, despite the dire reports that are seemingly coming out every day about Social Security, Alp and I and our team, we fully expect Social Security to continue to be an important part of your and my retirement. I expect to receive Social Security. I'm currently 46 years old. I'm not eligible for it yet, but I expect to receive it. But I alluded to this a moment ago. Do I think full retirement age for me is going to stay at its current age, which is age 67? Nope. I think I'm kind of that age that it's likely that at some point Congress is going to enact some changes to Social Security, one of which will be to bump out that full retirement age. Just as I mentioned, it started at 65. It was 66 for a number of folks, and then there's a window where it went up in 2-month increments. For me, under the current rules, it's age 67. But like I said, I expect at some point they're going to move that, as they say, goalpost on me. But I expect to receive Social Security. And there are any number of other, I'll kind of say, solutions to prolong the Social Security system that are actually relatively simple math equations, right? Social Security is light years simpler than Medicare. Right? That's an entirely different conversation to think about, how we as a country afford to continue the Medicare system. But Social Security, it's actually pretty simple, right? It's a math equation of, right, bringing in more revenue from Social Security than is going out in payments, right? And we know there's a large cohort of the baby boomers, right, that are going into receiving Social Security benefits. The workforce is paying those benefits. And so just a quick note, right? There's two components that go into the paying of Social Security benefits. There's the savings account or trust fund, and that's the piece that gets the news talking about under the current trajectory will run out of money by around 2032. If they don't make any changes. But even if that happened, even if the trust fund ran out of money, there's still all the active employees and their employers who are paying Social Security taxes, right? On every paycheck and pay a portion in that. And so that ongoing payments in and of itself actually would be enough to cover about 75 cents on the dollar, or the projections of committed benefits, right?
So that's without any changes, right?
Exactly. If they made no changes, if they didn't change the retirement age, if they didn't change the limits on the benefits, if they didn't means test it, right? I'm not advocating necessarily those, but those are many of the sort of variables that are being discussed for changing it and prolonging it.
And when Jason says it's a math equation, what we generally mean is it's just a mathematical formula: life expectancy, the amount of money that needs to be funded to maintain. They know who is going to be receiving it in what years. I'll just say, to me, one of the simplest solutions, if I was president of the US and I wasn't worried about getting reelected, I would probably, this is always a really difficult topic politically, but I would actually just raise the employee and employers' contributions into the system. Currently it's 6.2% for each of them. Raise it to 6.3, 6.4, whatever it takes, in addition to making the changes that Jason already talked about raising the age, more commensurate with how life expectancy has gone up in the future. I'll call it in a non-pandemic.
That would clearly be framed as a increased tax, right? And so that's where it's politically can be challenging.
It's political suicide.
But Social Security benefits are, the most popular, most successful, I'll say, sort of social program that this country has had. And a lot of people are dependent on it. And a lot of those folks who are dependent on it vote. So that's partly why we're confident that if changes will be enacted, it will be prolonged. The U.S. Congress is a deadline-driven organization. They're going to wait till the deadline. So one of the most common questions we also get is when do most people start collecting, right? And this doesn't necessarily mean just because it's the right for you, but just kind of interesting to know that actually most people start collecting benefits early. And you'll see there on the slide, which also means a reduced benefit. So here, this is just a really important concept to understand. You can file as early as age 62 or as late as age 70, but all benefits, when you go online or you get your benefit statement, are all based on your full retirement age, okay? And then if you file prior to your full retirement age, that's considered early, and the benefit is reduced, and we'll elaborate on that more. But the reality is about 69-70% of all folks who are currently receiving benefits filed early. And it's interesting, right, kind of to the issues around the trust fund running out of money, is folks are living longer, right? So they're drawing more out of the system. And as of 2022, there was over 1.7 million recipients of Social Security age 90 or older. And then it's important for everyone. It's invaluable for everyone, but particularly for women. Women on average live longer. And so it's really important to make a wise decision when it comes to the Social Security benefits. And as we'll talk about, it's not just about the woman making the decision, but if you're married, collectively making a wise decision. And we'll talk about why that's important. So just some other things we've already mentioned, but it's important to sort of take a step back and why is Social Security so important? Not only is it, it's a decent amount of income for a lot of folks, but you can't outlive it, right? It's guaranteed. It's kind of like a pension plan in this regard. It's a federally funded pension plan that they're going to pay you regardless of how long you live. It comes with a COLA, or it's inflation adjusted, and it's guaranteed, right? So fewer and fewer retirees have any other sort of income that check those three boxes, right? There still are, some federal employees, state employees, a handful of private employers that still have those kind of traditional defined benefit pension plans. But for the most part, most Americans, it's Social Security that is their only form of income that kind of checks all three of those boxes. But will it be enough? Okay, we've talked about, yeah, it's a valuable benefit in retirement. But for most folks on this call and the folks that we work with, it's not going to be enough, right? Social Security alone is, and it honestly was never meant to fully replace your income from when you were working. It was meant to be one component along with your own personal savings. And in the past,
a social safety net, we can say,
a social
right?
safety net, absolutely, right? If you go back to when it came about, it really was a anti-poverty effort coming out of the Great Depression for retirees that were in poverty. But so absolutely great social safety net. So I always kind of like to share these stats because it's kind of interesting to know that on average, just when you look across the country, the average Social Security recipient, Social Security replaces about 40% of their pre-retirement income. Okay, now slice that a little bit further. For folks that were earning kind of above average, and I want to say in 2022, these sort of average wages across the U.S. were somewhere in the $60,000 a year. So if you are on this call and your average income was above that, it's going to replace a lower percentage, and it's generally can be around 30% or below. And then if your income record was sort of below average, it will replace a higher percentage. It can be as high as say 60%. But that's kind of gives you a sense for sort of what it's meant to where it's meant to sort of fit into a retirement plan and replacement of income. That's what more and more of the burden is falling on our own savings, right, to replace our income in retirement.
Yeah, and then I would say what you kind of talked about, just for our client base, yeah, it's not what they're relying on. Generally, it's more the factory workers in some of the more industrial towns that Social Security, if they don't have a pension plan, is pretty much their sole source of retirement income.
Yeah. So just a couple other important kind of data points to understand about how they calculate your benefits. And we got a question ahead of time about this, so hopefully we'll answer this directly for everyone. To earn Social Security, to qualify for Social Security benefits, you need to have earned 40 credits, and you can earn up to 4 credits a year. And it's a relatively modest income base. So in 2023, 1 credit is earned for every $1,640 that you have of earned income that's subject to Social Security tax. So it's pretty modest level, relatively easy to earn your 4 credits a year. So basically you need to work, pay into the system for 10 years to qualify for Social Security. However, your benefit is then based on your highest 35 years of earnings. Okay, we had gotten a question ahead of time around, do they look at your most recent 3 years, right, or your highest 3? That's where you're probably sort of confusing that with the federal pension program, right? Federal employees who get the civil service or the FERS program, that they look at the high 3. Social Security is just your highest 35 years of earnings. And you might say, well, you know what, I actually only worked and had earnings for 32 years. Well, then it's going to be based on those 32 years. And then there will essentially be sort of 3 years of zero that kind of go into the calculation.
And I'll add, if you keep working while you're collecting it, they will recalculate. You'll now have 33 years into the system, 34 years, 35 years.
Yep. Thanks. And then,
so Jason, I'm going to give you one quick question we get a lot.
Yeah.
What's the best practice for everyone when it comes to reviewing your work history in regards to Social Security?
Yeah, thanks for bringing that up, because it is a best practice, and we encourage anyone of any age, even if you're many years away from qualifying for Social Security, to do this. Go online, ssa.gov. You see it right there on the web page or on the screen. If you've never done it before, you'll just create a login, right? It's a personal portal to log into, then view your earnings history and your projected benefits. And to Alf's point, what's really helpful and what you want to do is go look at that earnings history. It's going to show every single calendar year that you worked and paid into the system, all the way back to that first job you had in high school, college jobs, out of college, right? Every single year. And if you were ever out of the workforce for a period of time, you'll see that, there were zeros, right, for a number of years. And that is the record that they're looking at to calculate your benefit, right? To determine the highest 35 years. On occasion, and we've read that the Social Security Administration says about 20% or 20 to 25% of those records have errors or are missing years where you did actually work and pay in, but they didn't get notification of it. It's not, on your record. It's generally not a fault of the Social Security Administration. What we oftentimes see is it may have been a small employer, or maybe an employer that actually went out of business after you were working there, and they just never reported your earnings to the Social Security Administration. And so what you can do, because I know you were going to ask this follow-up question now, what can you do if you find an error, right? There is a process. Social Security Administration has a process for that, where if you have the W-2 from that year or the tax return from that year, you can submit that. They'll work with you to get it updated. And here's why we want to do it even if you're young now, because you don't want a lot of years to pass and then discover it, because then it can be more difficult to prove it, right? You may have gotten rid of those tax records, but even if you did, the IRS has a process of requesting old tax returns. They charge you a fee, I think it's like $40 or something, to get an old tax return that you could then submit to Social Security. But yeah, and it's also just an interesting exercise to go back and, a little walk down memory lane, look at, oh yeah, I remember that job where, that summer I made, a couple $1,000s, or, and then, as I mentioned before, it will also show you your projected benefits, and it'll show you at 3 different ages what your projected benefit is. And so here, let's sort of talk about that. It's going to show you what your projected benefit would be at the earliest possible age, which is age 62. That's universal for everyone. Age 62 is the earliest age. Well, a caveat on that. Universal. I'll come back to that in just a moment. Age 62 is the earliest benefit, or earliest age you qualify for benefits. And then you can delay, we've already said this, to as late as age 70, right? However, the full retirement age is really what the Social Security Administration bases all your benefits on. A term you all want to be familiar with is something they call your PIA, or primary insurance amount. All that means is that's the amount of money you're projected to receive at your full retirement age. Okay. And everything is based off of that number. So then if you file early, it's going to be a reduced benefit, right? If you delay it, they're going to give you what are called delayed retirement credits. So you see there on the right-hand column, 8% a year. They're just for waiting. They're going to increase the benefit. That's in addition to any COLAs that I'll mention. It's in addition to if you're still working and paying in and adding to the years of service, right? So there can be, can kind of be a triple benefit of waiting to 70 to get those delayed retirement credits. 8% kind of guaranteed return isn't bad. And then in the middle column, you can see the percentages of the reduction, right, all the way down to age 62. And then, it's a lesser reduction for each year that you wait, right? So if you filed at age 63 or 64, it's still reduced off of the full retirement age, but not as much as age 62. And then there you see the full retirement age is under the current rules. Like I said, I fall under that age 60 and later, birth year. So under the current rules, 67 is my full retirement age. Like I said, I consider myself in the cohort that's probably going to get bumped out to 68, 69, who knows, right? They might do it in increments like they did back in the 80s. Ronald Reagan and Tip O'Neill and Speaker of the House worked together, and they bumped out the ages. And so it went up to 66. And then for birth years of 55 through 59, it goes up in 2-month increments. So it's 66 in 2 months, 4 months for until you get to 1960. It's a really important concept to be familiar with, and that's what you'll see on the website or the paper statement. If you still get those, they'll show you what you qualify for at 62, at your full retirement age, and at age 70.
And I'll say the hardest question of all is, what age should I start collecting at? And because nobody knows what their life expectancy is, it's just an impossible question to answer.
Generally speaking, right? Now there's a lot of logic, right, that goes into considering, okay, are you married? Were you married? Disparities in income, right? You can hone in on making a good decision, but ultimately, right, Alf's right. If you know exactly your life expectancy, we could tell you exactly when to file for Social Security, right?
And for some people that have had health histories or family health histories, it does become a little bit more of an educated guess.
Yep.
Where we've had people tell us, oh, the men in my family haven't lived past 76. Mm-hmm. So in those scenarios, generally wouldn't make sense to delay collecting it past your full retirement age.
But kind of to that point, we just thought this slide does a really nice job of sort of emphasizing the differential for waiting, right? So in this case, what we did is we just set a baseline. This person's full retirement age is 66. So their primary insurance amount is $2,000 a month, just using simple numbers, right? So we talked about if your full retirement age is 66, it's a full 25% reduction if you filed at 62, right? So then that's sort of the $1,500 is kind of the starting point, right, of what you could start receiving. And then you see each year, if you were to wait, the dollar amount and the percentages that it goes up. Right? So 76% higher benefit if you were to wait all the way to age 70.
Jason, you do it year by year. Does it matter month by month?
Yeah, great point. Yeah, we sort of simplify it by just showing it by year, but Alp's exactly right. It's month by month. It's pro rata for each month that you wait. So you could file it, 63 in 9 months or 68 in 2 months, and all these sort of the pro rata of delayed retirement credits or the reductions are based on.
And on a later slide, we will get into for families. Mm-hmm. It could make sense for somebody to delay it because their potential future surviving spouse could benefit from that election of delaying it.
Yep. Yeah, you sort of touched on that a moment ago of, life expectancy obviously is an important variable, but if you're married, it's really kind of your joint life expectancy needs to be taken into account.
Because of my CPA background, I think I'm only qualified to talk about a few things on this slide, but when it comes to taxation of benefits, we get asked this a lot. There's only 11 states that tax Social Security benefits. I've got Colorado, Connecticut, Kansas, Minnesota, Missouri, Montana, Nebraska, New Mexico, Rhode Island, Utah, and Vermont. For those locally to us in DC, Maryland, DC, and Virginia do not tax your Social Security benefits. And you'll see the little thing on the bottom. No one pays federal income tax on more than 85% of his or her Social Security benefits based on IRS rules. And basically, there's a phase-in when that happens. That was actually one of the questions we had. But for most people, if they've got investment income or if they've got a pension, they're generally going to pay tax on their Social Security benefits. If all you have is Social Security benefits and virtually no other savings, you generally will not pay tax on Social Security, not just for what it says here, but just the way the tax code is created for people with lower income brackets. You just don't pay much tax, if any.
Yep. And we sometimes get asked, wait, they're going to tax my Social Security at 85%. No, Alp said it correctly, but every now and then folks hear that and they think, no, it's only 85% of the Social Security benefits is included in your taxable income when you fall within these.
And they always want to raise that. However, they get a lot of pushback because the Social Security tax you pay into the system is paid in on an after-tax basis. If it was paid on a pre-tax basis, they would tax 100% of the benefits.
Yep. So, all right, this is another really important concept to understand about how the Social Security benefits work. And this is to that point of filing early. So again, when I say filing early, what I mean is filing at any point prior to your full retirement age. All right. So not only is there the reduction that we talked about a moment ago, just by percentage wise, because you're getting it early, right? There's also a potential withholding of benefits if you're still working. And if you're still working and earning above the thresholds you see here on the screen, the Social Security Administration will withhold a portion of your benefits. So you can see that if you file under your full retirement age in 2023, if you have income above $21,240 a year, for every $2 earned above that threshold, the Social Security Administration is going to withhold $1. Okay, and that withholding, they do kind of a little bit of a complicated accounting, so it's not completely lost forever. Once you get to full retirement age, they will kind of recalculate and kind of add back what has been withheld. And that's the other important concept you see on the bottom line there. So starting in the month that you reach your full retirement age, and from that point forward, there is no withholding for earning and working, right? So I always like to kind of boil this one down to if you're still working, still earning money above, relatively modest threshold there, it generally does not make sense to file for Social Security benefits early, prior to full retirement age, right? Not only because of this withholding, but in addition to that, there's that permanent reduction for the rest of your life that I've already talked about. And hopefully if you're still working and earning, you don't need it yet. And so there's the benefit of letting that, letting your benefit continue to grow. So that's just kind of should be a red flag thinking about filing early. Well, if you're still working, probably doesn't make sense.
And I'll add that the IRS has the capability to track how much you're earning through W-2s, through 1099s. A little bit different when you're self-employed. If you're self-employed and collecting early because you're just working part-time, a little bit on a self-employment basis, they will at the end of the year ask you how much you made, like on a net basis, and when you actually made it during the year, so that they have forms that go out to try to track this.
All right, so just kind of a quick recap of what we've gone over so far before we get into sort of the spousal and ex-spousal benefits, right? So far, we've really kind of been focused on just your own work record, your own individual Social Security benefits, right? They're determined based on your highest 35 years of earnings. You qualify for benefits having worked 10 years, earning 4 credits a year at 40 credits, or it could be disjointed, right? You could have only worked enough and earned 2 credits 1 year and so forth, right? But the point is 40 credits. And then you can file as early as age 62, it'll be reduced, or at your full retirement age, or delay to 70. Hopefully all that makes sense, right? That's kind of the core framework for Social Security benefits. You see the asterisk here. I'm going to talk a little bit about sort of the potential restrictions for federal retirees and how Social Security works with their pensions, but we'll hold off on that. Okay, spousal benefits. So how are spousal benefits determined? It's equal to up to 1/2 of your spouse's benefit, right? Or their PIA, or their primary insurance amount at their full retirement age, if greater than your own, right? So it's kind of the higher of the two, either 1/2 of your spouse's or your own. Who qualifies? Spouses as defined by the federal government. So same-sex marriages have officially qualified now for a number of years, and you've been married at least 1 year. You'll notice that a spouse doesn't necessarily have to have the 40 credits. So if we kind of go back to the original sort of purpose of Social Security as a social safety net, there were a lot of spouses that didn't sort of work outside of the home or the family farm or so forth, and didn't necessarily pay into the system. So there was a recognition of that, oh, you know what, we need to protect spouses who aren't necessarily a part of the quote unquote formal economy, right, and paying into the system. So just an important note there. And spousal benefits kind of work the same way. You can file for spousal benefits as early as age 62, wait till the full retirement age. However, there are no delayed retirement credits for waiting beyond your full retirement age. So it's capped at 1/2. Okay, so that is the maximum amount. Always remember, if you're filing for any kind of benefit, your own, a spousal, a widow's, an ex-spousal, any of them, if you're filing to receive prior to your full retirement age, it's going to be reduced because that's considered filing early. So always remember that. So let's talk a little more about ex-spousal benefits.
I know we got a question on this.
Okay, great. So I'll make sure I answer it here. If I don't, let's touch on it directly. So again, how ex-spousal benefits are determined similar to spousal. It's up to 1/2 of the ex-spouse's full retirement age benefit, or your own, whichever is greater. Okay, you qualify having been married at least 10 years, been divorced at least 2 years, and have not been remarried. Generally speaking, if you get remarried, you're now kind of tied to that new spouse's work record. So I always half jokingly say, if you're thinking about getting remarried, on the first or second date, ask for that Social Security statement to compare. But when can it be claimed? Same idea. You can file early, starting as early as 62, wait to full retirement age, which would you would qualify for up to 1/2, again, because that's the maximum amount, because there are no delayed retirement credits. And I think I know what's question here. I did not address it yet. So we are going to talk a little bit more about kind of what's called a restricted application. But we had a question for ex-spouses. Can I file and just start receiving a benefit off of my ex-spouse's work record, and then not my own, and then later switch to my own? Is that a fair synopsis of the question?
I would agree with that question.
Yeah, okay. So I'm going to say now it used to be more common. Several years back, they changed the rules and it's been fading out, and we're getting really close to the end of the phase out. So in most circumstances, the answer will be no to being able to do that. You can only file what Social Security calls a restricted application to claim ex-spousal benefits alone and postpone claiming your own benefits if the following are true. You were born before January 2nd, 1954. That's the piece that's that's phasing out quickly. So that's one component. You have to have been born before January 2nd, 1954 to qualify to do that restricted app. Then the other items apply. You were married at least 10 years. You're currently unmarried, and your former spouse has filed for his or her own Social Security benefits, or your ex-spouse is at least 62 years old. And then that turns on the ability to file.
But to clarify,
please.
I could actually, if my ex-spouse has a nice benefit and my benefit was low, I can still collect the higher of my own benefit and my ex-spouse's benefit, one half.
Absolutely. That's still the case. Yep. But it's going to be, you're going to kind of be forced, you'll get the higher of the two.
And I'll say, we'll summarize it as a few years ago, they basically are shutting down the double dipping part of it, where people were just enjoying delaying their own benefits and collecting an ex-spouse's benefits. So you're seeing those type of loopholes shut down.
Yep. So it's making our life a little simpler, I'll say, but it's not as good a kind of strategy, as many strategic options for folks.
But we've had a lot of really happy people that found out that they could, if they qualified for it. Oh, that's really fascinating.
That's some free money I didn't expect to get.
And they delayed theirs till age 70.
All right. So now another potential sort of pool of benefits are survivor benefits, right? Widower benefits. So the survivor will receive the greater of the two benefits. And what do we mean by the two benefits? Either your own or your deceased spouse's benefit, right? So you get the higher of the two. I know we had a couple questions on that, just clarifying it's the higher of the two. Technically, the way it works, so if my spouse were to predecease me and her benefit were higher than my own, what happens is I continue to get my own, and then the Social Security Administration kind of gives me a raise to bring me up to what the survivor benefit should be, the equal amount that my spouse was receiving. So that's technically kind of how it works, but it's just the higher of the two. So you qualify, you need to have been married at the time of death, married for at least 9 months. There are a few exceptions for military service or accidental deaths, that the exceptions to that 9-month requirement. Okay, now here was, I gave a little disclaimer earlier. This is the one instance, and I think we got a question on this one too. At what age can you apply for widow or widower benefits? And here, this is actually age 60. Okay, so as a survivor benefit, you can file as early as age 60. But remember, that's considered filing early, and it will be a reduced benefit because you're not waiting until your full retirement age to file. And same deal, there's no delayed retirement credits. It's just the higher of the two.
Jason, I have a question.
Okay.
It says, my wife is already retired. I plan to retire next year. She would benefit from receiving 1/2 of my full retirement benefit. Do I file for her spousal benefit when I retire, or does she file for the spousal benefit when I retire?
Interesting. So I'll start with there at the end. She is the one who files for the spousal benefit. Because technically it's sort of her right to a spousal benefit, kind of frame it that way. However, you will need to have filed, right? That's kind of,
so the window has to open.
Exactly. Yep. So what I mean by that is Chris, it looks like you would need to have filed to sort of turn the window on or turn the spigot on for your wife to then be eligible for her to file for the spousal benefit.
And I will give out one of my fun facts, because most people on this call know Johnny Carson well. Johnny Carson provides an interesting illustration of this rule for I'll call it the survivor benefits. He was married 4 times. Each marriage lasted over 10 years. And none of his former spouses remarried. So upon Johnny Carson's death, all 4 of his ex-wives qualified and received an amount equal to his full Social Security benefits. That costs the system
That's
a
why
lot of
we're
money.
running out of money in this system.
Silly
Yeah.
rules like that.
Oh yeah, that always cracks me up thinking about that case. Because I remember Johnny Carson. So just a real simple example, kind of bringing things together, what we've been talking about. Husband and wife, wife age 65, husband age 79. Big difference here in age. At age 79, the husband passed away. His Social Security benefit was $24.84 a month. You see, moving along the timeline here, wife files for spouse only survivor benefit at her full retirement age. She'll get the $24.84 a month, not taking into account any cost of living adjustments, right, that may have gone into it at that point. And as a survivor, because she waited and filed at full retirement age, then she could wait till defer her own to age 70 and switch and get her her own benefit, which in this case is higher. So this is an interesting scenario for some survivors to think about. Hey, I could at my full retirement age apply for that survivor benefit based on my spouse's record, and then if my own benefit's going to be higher at 70, you could potentially switch. Here's a couple of the loopholes that Alt mentioned. There used to be something called file and suspend. Does not exist anymore. No one else is eligible for it. I'm not even going to cloud anybody's understandings to talk about it further than that. I've already sort of talked about the restricted application piece of it, and that window is closing quickly. Again, it had to have been born before January 2nd, 1954, or in other words, had to have attained age 62 by January 2nd, 2016. Then you may still be eligible for a restricted application when you get to your full retirement age.
And that pertains to married people, or who does that pertain to?
Both.
Got it.
Both.
Okay.
Yep. For ex-spousal benefits.
But you had to have
or
been married.
Spousal benefits.
It's
That's
just
right.
not a single benefit. Yes.
That's right. That's right. Yep. Great. So moving along here. So I just explained that. So there you go. All right. So this chart hopefully just kind of gives a simple example. We have a married couple, both with full retirement age of 67, right? Because you see their birth year was 1960. That's the first year that full retirement age became 67. And a significant difference in projected benefit amounts. So spouse one has a full retirement age benefit projected to be $2,500 a month. Spouse two has $1,000 a month projected. So this is an example of the lower earning spouse potentially filing it early at 62. So we just kind of want to explain sort of some of the variables that go into thinking about when to file, right? So in this case, let's say both are retired, no longer have income coming in. The younger spouse might say, all right, I want to go ahead and get some money coming in. I'm going to file at 62. So they're going to get a reduced benefit, right? They're not going to get $1,000 a month. They're going to get $750 or so of benefit. Then in this example, we're having spouse one, the higher earning spouse, delay all the way to 70. Okay. So because of their birth year, they're not eligible for the restricted application we talked about. But what does happen in practice in this scenario, spouse two is getting their reduced benefit all the way until spouse one turns 70 in this case, because that's when spouse one files, which then, as we talked about a moment ago, kind of opens the window for the spousal benefit for spouse two to receive. So they would then get a raise, but it's not going to be all the way up to 50% because they had filed early at 62, but it still get a raise because 1/2 of spouse one's benefit is higher than spouse two's benefit. So here, sorry, it's a little bit busy, but hopefully you can kind of see the numbers in practice, right? So 2022, their age is 63. You see going into 2026, this one, sorry, this shows, okay, yeah, getting $1,000 a month spouse two, because this chart actually presumes them filing at full retirement age, right? So they get the full 50%, or get
Some additional
they get
benefit.
their own benefit of $1,000 a month. Then at age 70, when spouse one files, they get $1,250. So why is it $1,250 and not half of $3,133? Because it's half of spouse one's full retirement age benefit,
which was $2,500.
Which is $2,500. You got it. So sorry, jumped around a little bit there on you, but hopefully that makes sense to everyone.
And Jason, that's a great slide also, just to talk about the survivor benefit, where let's just say spouse one died at age 80.
Mm-hmm.
What happens to spouses two benefit? And you can see.
Hopefully we made this clear to everyone. Everyone knows that answer. Yep. So in essence, if spouse one dies at age 80, spouse two will get $3,133 a month.
And
right? The $1,250 basically goes away.
And they're getting the benefit of the growth from delaying from full retirement age to age 70. So the $2,500 benefit now goes to $3,133 in the event of a premature death.
Yep. So that's where we talked about the value of considering your joint life expectancy, because when we've run into this in a number of occasions. I'm just going to pick on the men for a moment. Let's just say spouse one is a male, and spouse two is a female. And I'm just making that example because the life expectancy, right? Generally speaking, women have a longer life expectancy. So in this case, the male might say, well, why would I wait till 70 if I'm not expected to live a long life, right? Shouldn't I start mine earlier? Well, if you were single, that would make sense. But thinking about it collectively as a couple, to Alb's point, you got to think about how long at least one of you is going to live, right? And so
who had the higher income.
Exactly. The higher benefit in this example makes sense to delay to 70 to lock in that highest possible benefit over their collective lifetime. So great point. And
I'd like to also point out before you get started on the slide, Jason, is just when you look at the total benefits that people can receive over a lifetime, it really is astronomical for people that are living longer lives. The amount of money that comes into the system, into the household, really is very generous. No different from anybody receiving a pension. The longer they live, the benefit is tremendous.
Yeah, this example, kind of average kind of benefit amounts, nothing at the high end, without any cost of living adjustments, is over $1 million of benefits received, right? Because we just kept it simple and just kept the amounts level. But we know there's COLAs involved in there, so that number would be much bigger. But so this chart shows the example where spouse two, the lower earner, filed early at age 62 or 63. They get their reduced amount, because remember their full retirement age amount was $1,000 a month, but they filed early, so it's reduced to $713. Spouse one still waits to 70, gets their $3,133 amount, but instead of getting $1,250 in this case, they get $963, right? So because that's based off of $1,250 was one half. That's the maximum they were eligible for, but it's reduced because they started benefits earlier. So that's why it's $963.
Always a math problem, and the difficult part, as we've said all along, is just life expectancy.
Yep, and that's where there's another concept, and that's kind of what the red bar is representing: the break-even age or the crossover age. This gets written about a lot. If you ever spent any time online looking up, hey, when should I file for Social Security? It's a question of life expectancy, and so for a single person, if you're comparing starting benefits at full retirement age or age 70, hey, should I start it at full retirement age or wait? Actually, the break-even point is usually around age 82 or 83, right? So as a single person, you would say, oh, if I expect to live to at least age 82, and I can afford to not have Social Security start for those 3 or 4 years between full retirement age and 70, then you're going to get more out of the system by waiting to 70 if you live past age 82. That's kind of the simple piece of it. But as we've hopefully made clear, it's not as simple when you're married and you're thinking about joint life expectancy. So that break even gets pushed out because you got to think about both of you.
And Jason, before you go on to that, I just want to go back to one of the questions that came in before.
Okay, great.
If I'm on long-term disability and go on Social Security disability, will it interfere with my Social Security amount when I start to draw?
So I'll just speak to my experience here, I am by no means an expert on Social Security disability. That is kind of a little bit of its own animal. But in every instance that we've seen that kind of scenario plays out, where somebody has qualified for long-term disability on some kind of private policy, those contracts, and every example I've seen, have a provision that requires you to apply for Social Security disability. And if you are approved for Social Security disability and start receiving Social Security disability benefits, they will offset, or they'll lower the amount that you're getting off of the private disability policy. That's kind of the scenario that I see playing out in that case. But maybe there's more to the question than I'm understanding. So please feel free to reach out to us directly if there's wanting to understand more. All right. So couple just quick comments on windfall elimination provision and government pension offset. So what these are related to federal retirees who are receiving federal pensions. So the old civil service CSRS or the FERS, Federal Employee Retirement System pensions. And so the windfall elimination provision comes into play for the retiree, right? And so, in just the short version here, and if this applies to any of you and you want to talk more about it, reach out. We can talk more details. But the quick version is the windfall elimination provision says that, hey, we're going to reduce a portion of your Social Security benefits based on your federal pension. And that reduction gets reduced or eliminated as you have more years of employment and work outside of your federal employment. So there's one of the misconceptions that we often run into is people think that the windfall elimination provision means that you don't qualify for Social Security. No, it just means it's going to reduce your Social Security. So just keep that in mind. Government pension offset applies to a survivor benefit of a federal pension, right? So my father is a federal retiree. If he were to pass away and my mom starts receiving his survivor federal pension, she would be subject to the government pension offset. So it would reduce her Social Security. So that's all that those mean. So just want to make that point of don't just assume that you don't qualify for any Social Security because you're a federal pension recipient. It just means that they may be reducing your Social Security. So we've hit on a lot of these, just kind of want to bring it full circle a little bit. Really important kind of questions and things to be thinking about. Am I really retiring, right? Am I stopping work? Or am I still going to have income? If I'm still going to have income and I'm not yet full retirement age, probably not a good plan to file for Social Security. What's my spouse's age, and is there a big difference in our ages, big difference in our life expectancy and our benefit amounts? Am I going to work part-time? Just right, just kind of reinforcing that point we've been making throughout, that it's important to think about it beyond just the I know there's friends talk, and there a lot of times it's just about, it's going to run out of, the system's going to run out of money, you should file for it as soon as you can, because you're not going to live, maybe you're not going to live long enough to get it. We hear that all the time, that folks say, well, that's what my friends are telling me. There's more to it.
And we have situations where somebody has a certain amount of retirement savings, and it might make sense for them to wait till age 70, but if they retired early, we have people that retired in their 50s, and to some degree, I'll say they're almost tired of drawing down their own personal savings and investments. Sometimes they look at it a little bit differently and say, you know what, I'm going to collect Social Security, whether it's early or at full retirement age. They just don't want to continue to stress their savings, especially in, I'll call it, turbulent times. Where, if they're pulling money out and the market's going down, they're like, you know what, I'd rather take a pause and point out and actually start collecting Social Security. So you see different strategies.
Yeah,
strategies can shift.
Yeah, we say it all the time with clients. It's a year to year, it can even be a month to month analysis, right? Because have a lot of retirement plans working with clients and might think, okay, the plan A is to wait till 70, but life changes, the markets change, and somebody might say, you know what, it's just making me really nervous drawing out of the retirement plan. I want to start that Social Security. All right, let's run that kind of analysis. we've talked a lot about life expectancy. Just thought it would be kind of interesting to see kind of the current tables, and as hopefully it makes sense, right? Like this is sort of at birth, like current life expectancy. Then as you attain these various ages, we didn't coincidentally choose 62, 67, and 70, right? Because those are kind of the important Social Security related ages. Sort of what's life expectancy, you know, again, on average across the country for women and men. And then kind of bringing it full circle, Al brought this up at the very beginning. Oh, wait, sorry. I'll come back to that. So here's that maximum benefit, right? So Al mentioned the age 70 of 45, 55 a month. The maximum full retirement age benefit in 2023 is 36.27. And the maximum age 62 benefit is 25.72.
Really, it just adds up to a lot of money any which way you slice or dice it. I mean, it's a lot of cash.
And then always like sharing this kind of history of the cost of living adjustments. We talked about 2022, 8.7%. 2021 was a pretty big jump from the prior years. You see prior years were relatively low. There were a couple of zeros there. 2015, almost practically zero in 2016, zeros in 09 and 2010.
Very low inflation years.
For a long time, right?
We've gotten to the last couple of years.
You have to go back to the early 80s, right? For anybody, you know, I know anybody had mortgages back then. You're like, oh yeah, I remember those high inflation, high interest rate years. So thank you. We're coming up right on the hour here. So we'll just close with a few just sort of tips, if you will. We've already encouraged people, if you haven't done it already, go to ssa.gov, create an account, log in, review your benefit history. If you're getting close to applying, actually the website is really intuitive. We've had a lot of clients apply online. We've helped different clients with the application online, whether it's for your own, spousal, survivor. But in some instances, some folks are just more comfortable, or there might be some complicating factors where you want to make an appointment and actually speak to somebody or go in person. You may need to bring evidence of birth certificates, marriage certificates, divorce decrees to provide evidence. And in a lot of instances, the Social Security Administration is able to access that stuff through their databases, so they don't need that evidence. But there are some instances where there's some gaps in their system, and they may say, hey, you need to bring in proof that you were married and when you were divorced, that sort of thing. I think
I was on a call recently trying to validate somebody's marriage of a deceased spouse that was a lot older. And it was interesting, I'll say, some of the questions that they actually had the answers to that actually challenged our clients. Like they were asking questions from 20 years ago, and it was interesting trying to figure out what the real answer was. So they can challenge you on that. So keeping the documentation is a lot more helpful.
Yeah. So check out our website. We've got materials on a presentation called Decluttering Your Financial Life. It talks about document retention, to Alp's point. But we've got a lot of recordings of workshops, blog posts, handouts, infographics on a lot of different topics. So please check us out at afsfinancialgroup.com. Here's our team. We'll just close with what we started. Please don't hesitate to reach out if we can help you with anything, if you have any questions. I think we covered all the questions, Alp. Is that?
I think we got it. I have scrolled through it. I feel comfortable we've covered. If we didn't, please feel free to send us an email and we will address it.
Awesome. Well, thanks everyone. Have a great rest of the day.
And Marty, thank you for that kind word.
Yeah, appreciate you tuning in. All righty. This will be recorded, and we will send out the recording with the slides.
Take care.
All right. Bye, everyone.
Bye.